Well, let's welcome in Ed Yardeni, President at Yardeni Research. He's joining in now. Ed, good to have you with us here. You once sort of called FOMC the Federal Open Mouth Committee, although we won't have open mouths this week because the Fed is in the blackout period now, all the way to the meeting in May. What's your sense, though? I mean, the market is fully priced back that 25 basis point rate hike in. Are we going to go into it like that, or should we expect further changes? What's your sense?
Well, I think that there's a case to be made for the FOMC when they get down together and discuss the latest data, that they might actually conclude that because of the banking crisis, they don't want to exacerbate it. And so they may not raise the Fed funds rate by 25 basis points and may make a very convincing case that because of the banking crisis, the federal funds rate is restrictive enough and doesn't need to be raised anymore. On the other hand, they may just go ahead and do the 25 basis points because they've been talking about 5.25% on the Fed funds rate for some time. And in that event, I think they will still say that they're going to pause. I'd be pretty shocked if they didn't pause in the face of the banking situation. I think the market would take that pretty well. The problem is we now have a deficit debt problem crisis about to occur, and it looks like it's going to come sooner than expected, maybe in early June.
Okay, so you're expecting a pause this time around, and the bigger issue really is a debt crisis that the U.S. is perhaps staring at. So do you think this could be the end of the rate tightening cycle, both globally in the U.S. as well as in emerging markets like India?
I do think that we're at restrictive levels now on short-term rates. I think the bond market agrees with that because we have an inverted yield curve, certainly in the United States. And inverted yield curves are usually an indication that fixed income investors think that it's all right to buy a bond at a yield below, say, a two-year yield, because if the Fed continues to raise interest rates, we'll get a financial crisis, a credit crunch, and a recession. So we're kind of in that zone right now. And the question is the Fed really going to want to push it over the edge, or are they going to come to the same conclusion that I think a lot of us are coming to, and that is no más, as they say in Spanish. Enough's enough. You've got the restrictive. Now, if you want to keep it there, that would be consistent with what you've been saying.
Morning, Mr. Yardeni from here in India. But what about equity markets? We saw a bit of a bounce. I think you have been maintaining that stance that the lows that we saw in October 2022, that will hold out. You think we could revisit that or still hold on to that view?
The October low last year was the low, in my opinion, and I came to that conclusion because I saw that sentiment, the bull-bear sentiment, was as bearish as it was back in March of 2009, and surely things aren't as bad as that. But right now, I think the market's going to continue to trade sideways, maybe north of 4,000. And again, I think on the bullish side will be the notion that the Fed is done for a while. We'll take a pause, even after a 25 basis point increase. But if they increase it, I think they're going to announce a pause. But on the other hand, we've got this debt ceiling crisis, which is coming to a head rather shortly. But I think that'll get resolved as well. But it may take a little bit more drama, and the kind of drama that depresses stocks for a while.
We had a view from Citi last week. Matt King of Citi basically talking about how he thinks, he described it as, he expects pressure to suddenly drop for markets because he thinks, liquidity is still winding down in the backdrop, although we're not talking about it very much.
Right.
The Fed's balance sheet is still shrinking, etc. How much would you agree with that point of view?
Well, not a great deal, because when I look at, for example, the money supply, the M2 measure, it's still about $1 trillion above the pre-pandemic trend line. The same thing goes for demand deposits. There's still a tremendous amount of liquidity left over from the binge that we had as a result of the pandemic. And as we know, there's a lot of liquidity that's sloshing around in the system. Right now, it's looking for better yields from the banks. The banks are being forced to raise their interest rates. Many of them are protected because their loan yields are also going up. But all in all, I mean, certainly we don't have the kind of liquidity we had when we had quantitative easing and when the Fed funds rate was zero. But all in all, I think that the resilience of the economy is really quite impressive. And I think there's still plenty of liquidity to keep the economy growing and to allow the stock market to go higher. Not immediately, but I think later this year, I think we'll see the market moving towards 4,600 on the S&P 500.
Okay, on that very optimistic note, we will end this discussion. Ed Yardeni, thanks a lot for joining in. So yes, these are volatile times, but the market could move higher by the end of the year. And perhaps there's a pause coming from the Fed. That's the word on the markets. Let's slip into a quick break. A lot of numbers to track this morning. Apart from ICICI Bank and Reliance, there's also names like Lodha that reported their numbers. You have other companies like Sun Pharma and Focus as well. All of that and more coming up in just a bit.